They told us Harley would always bounce back, no matter what. But the numbers coming out of Milwaukee right now tell a different story. Profit on each bike has been squeezed down to a thin 5 to 6%, instead of the fat margins that used to keep factories, dealers, and parts counters strong. Legendary dealers, some open for close to 100 years, have already shut their doors. And the finance arm that carries most new Harley notes is paying more to borrow money, which won't stay on some balance sheet. It rolls straight into riders' payments, dealer stress, and fewer chances for real discounts. Those are the signs you usually see right before a bailout, a buyout, or a bankruptcy hits the table. In this video, we'll walk through each path and what it means for your resale, your dealer, and your miles. Stay to the end so you know which future actually gives riders a fighting chance. Harley's margin meltdown. Harley did not get slammed into junk status because riders stopped buying. It happened because the money left in every bike got too thin to matter. S&P looked straight at the back to the bricks plan and said, in plain language, the margins are not there. The agency expects Harley's adjusted profit margin to hang around 5 to 6% through roughly 2026. Just a few years ago, it sat well above 16%. That gap is the whole problem. On paper, unit sales are not a disaster. Recent reports showed global retail sales ticking up, with North America even showing double-digit growth. Market share in heavyweight bikes in the United States even clawed back a few points after years of decline. So why would a company selling more motorcycles get marked as junk? Because those extra bikes are being pushed out the door, with far less profit packed into each one. Volume without margin is like running wide open in fifth with no oil pressure gauge. It feels strong right up until it does not. For riders, that thin margin hits where it hurts. Low profit means less cash to support warranties, to keep parts moving, and to help dealers stay alive through slow seasons. Junk status also means higher interest costs on Harley's own debt, which chews away even more of what little profit remains. Strip it down, and the downgrade is really a warning. The core business is not earning enough on every machine it sells. The real question becomes simple and brutal at the same time. If the margin went first, what part of the financing chain gets pushed to the edge next? The loan desk nobody sees. The next weak link sits where most buyers never look: Harley-Davidson Financial Services. Roughly 7 out of 10 new Harley riders sign their note through that captive finance arm. When S&P knocked Harley's main rating below investment grade, the finance unit took a hit of its own. Its debt slid from a solid investment level down into the high-risk bucket. That shift does not just hurt pride. It changes the math on every loan HDFS writes. Once the rating drops, lenders and bond buyers demand more yield to take the risk. That means higher interest costs for HDFS itself. According to analysts who follow the company, that funding spread can move by several percentage points after a downgrade like this. The finance arm does not eat that cost out of kindness. It rolls it straight into the rate a rider sees on the showroom desk. A payment that might have been manageable at one rate turns into a deal breaker just a few points higher. When the finance arm starts feeling the heat, the obvious next worry is simple. Who gets stuck staring at rows of unsold bikes while the interest meter keeps running? If you ride or wrench and want more straight talk like this, hit like so I know it helps, subscribe so you do not miss the update, and tell me in the comments how Harley's future looks from your seat. Floor plan interest. You can already see the answer in the stories coming out of longtime dealerships. Stores in Illinois, Pennsylvania, Colorado, and beyond have turned off the lights after decades in business. A century-old San Francisco dealer that once felt untouchable shut its doors for good. These were not hobby shops. They were anchors for their communities. A big reason they failed sits in a phrase most writers never hear: floor plan financing. Dealers do not pay cash for that line of fresh chrome on the floor. They borrow against it, often at rates in the high single digits to low double digits. Some dealer reports describe monthly interest bills between $25,000 and $40,000 just to hold unsold inventory. If bikes do not move, those numbers bleed a store dry. Corporate finally reacted and slowed shipments. Company updates have pointed to worldwide dealer inventory dropping by more than 20% over roughly a year, down toward the mid 40,000 unit range. That is healthier on paper. But that adjustment arrived after years when dealers begged for fewer bikes and got more instead. Those years stacked floor plan interest on top of weak margins and aging buyers. With that kind of damage already done, the obvious question hangs in the air. Why push so much inventory on dealers when the buyers were clearly slowing down? Strategy versus heritage. The answer sits inside the back to the bricks plan itself. Leadership chose to chase volume with cheaper, simpler models to bring new riders through the door. On one level, that makes sense. Younger riders have less cash, and heavyweight touring rigs priced like luxury cars scare them off. A lower entry price on a leaner machine sounds like a solution. Credit agencies and industry analysts see the other side. Those same bikes carry far slimmer profit per unit than the high-end touring machines that built Harley's modern balance sheet. S&P has signaled that even if market share climbs back toward the mid 40% range in heavyweights, the profit margin may still lag near that 5 to 6% band for years. More riders on lower margin machines do not fix the debt load, the tariff bite, or the cost of keeping a dealer network alive. With margins thin, finance strained, and strategy pulling against the old identity, the hard question becomes unavoidable. If the current path trades away soul for survival, who, if anyone, can still steer the company back toward the road its riders actually trust? Bailout cash. When people hear bailout, they picture a white knight saving a dying brand. In reality, bailouts are closer to a tourniquet on a bad leg. They stop the bleeding for a while, but you still limp. Harley has already lived through a version of this. During the financial crisis in roughly 2009, Berkshire Hathaway stepped in with a $300 million loan at a brutal double-digit interest rate. That money kept the lights on and the factory humming while credit markets were frozen. It did not fix the deeper issues, but it bought time. A modern bailout would likely look similar. You would see a large investor, a consortium of banks, or even a government-linked fund offer a bridge loan. In exchange, they would lock in high interest, covenants on how cash gets spent, and probably a say in future strategy. According to restructuring attorneys who follow these deals, lenders often demand limits on dividends, asset sales, and big capital projects until the debt is under control. The company gets breathing room, yet every major move has to be cleared through people who care more about payments than about riding seasons. The nagging question hanging over the bailout idea is simple. Who would be willing to wire that kind of money into Milwaukee today, and what control would they insist on seizing in return? Who'd really own Harley's soul? Another path people like to dream about is a buyout. In that picture, fresh owners ride in, clean house, and restore the brand to its former glory. Sometimes that happens. Other times, the new boss treats the company like a parts bike, stripping everything valuable while the shell rusts in the corner. Which outcome you get depends heavily on who does the buying. Private equity firms and strategic buyers play very different games. A private equity shop looks at Harley and sees cash flow potential, real estate, a finance arm, and a powerful logo. Their playbook usually includes aggressive cost cutting, renegotiating supplier and dealer contracts, and trimming anything that does not show a fast return. On paper, that can boost profit quickly. In practice, it can mean fewer engineering jobs, tighter warranty budgets, and pressure on dealers to take whatever product mix corporate decides. A strategic buyer, like another large manufacturer, might be more willing to invest long-term. They could slot Harley into a broader lineup, share engines or frames, and use their own global network to smooth out tariff hits. So the real puzzle is not whether a buyout could happen. It is what kind of buyer would step up, and whether they would see a Road King as a crown jewel to protect, or as an old asset to slice apart for parts and profit. Wiping the slate, cutting the riders. When people hear bankruptcy, many think it means turning off the lights for good. In corporate reality, it often means wiping the slate and starting over with fewer obligations. Under a restructuring process, a company like Harley can ask a court to let it shed certain debts, renegotiate leases, and even walk away from some dealer or supplier agreements. Airlines have done this, car makers have done it, and plenty of big names kept operating right through the process. The logo stays, but the contracts underneath it change. Creditors in those cases line up and fight over who gets paid and how much. Bondholders might take a haircut on what they are owed. Some unsecured vendors might get pennies on the dollar. Pension and benefit obligations can be altered depending on the structure and the law. Dealer agreements can be trimmed or terminated, especially if the company argues that its network is oversized for current demand. From a cold legal standpoint, bankruptcy is a toolbox for cutting anything that drags cash flow down. It forces a tough reflection. If bankruptcy is the tool that finally makes the numbers work, who should shoulder the immediate pain so the reworked brand can roll back out onto Main Street looking healthy again? Fast liquidity levers. Before any of those big, dramatic moves become unavoidable, there is another layer to consider. Companies in Harley's spot usually run through every quick cash option they can find. These are the fast levers, the ones that can be pulled in months, not years. They do not carry the same headline shock as a bailout or a bankruptcy, yet they can decide whether those bigger steps ever show up. Liquidity, at its core, is about whether the business can pay its bills while it tries to fix the deeper problems. Common moves include selling non-core assets, such as surplus real estate, side brands, or financial portfolios that are not central to building and selling motorcycles. Management can also look for minority investors willing to buy a stake in a profitable division, like the finance arm, in exchange for fresh capital. On the working capital side, they can tighten inventory even further, slow payments to some vendors, or renegotiate lines of credit with banks. Each action buys a few more months of breathing room, though each also comes with a cost down the road. Selling hard assets limits flexibility later. Taking on new partners complicates decision-making. Liquidity levers can stretch out the runway, so the deeper question becomes sharper with each month they buy. Once the bleeding is slowed, what long-term strategy will actually make owning a Harley feel safe and proud again, instead of like betting your money on a brand still trying to remember who it wants to be? Bondholders in the saddle. The downgrade to junk status did not just sting Harley's ego. It fired automatic guns on Wall Street. Many pension funds, insurance companies, and conservative investment vehicles have rules that forbid them from holding junk-rated bonds. When S&P pushed Harley's rating below investment grade, those rules did what they were written to do. Managers had to start trimming or dumping Harley paper, not because they hated the brand, but because policy demanded it. That kind of forced selling can push borrowing costs higher overnight. Large bondholders are not just quiet spectators. According to restructuring advisors who watch these situations, major creditors can form steering committees and press for changes. They push for covenants, demand regular briefings, and sometimes insist on seats at the negotiation table when strategy is reviewed. Their priority is simple: protect the coupon and get their principal back. If that means cutting factories, shrinking dealer networks, or slowing product plans, they will argue for it. Love for V-twins is not part of their mandate. Creditors have the clout to set the tone in the boardroom once the rating falls. The uneasy question that follows is hard to ignore. If bondholders start pushing hard for a sale or a carve-up, who, if anyone, stands in the room to protect whatever is left of the Harley soul? Dealers' leverage and limits. For all that power on Wall Street, The �W𝐨𝐭𝐨𝐫𝐜𝐲, real heartbeat of the brand, still sits in the dealer network. Those shops are where buyers first swung a leg over a big touring rig, where veterans came back after deployments, and where local charity rides kicked off at 8 in the morning. Dealers are not just customers of the factory. They are partners, creditors, and sales agents rolled into one. When the numbers turn ugly, they have tools of their own. Dealer councils, made up of store owners from across the country, can coordinate responses to factory decisions. They can slow orders, refuse extra allocations, and push back on pricing or floor plan terms. Reports from the past few years describe dealers pressing Harley to reduce shipments and clean up bloated inventory. Eventually, corporate listened and pulled back, dropping global dealer stock by more than 20%. That happened because dealers would not keep swallowing machines they could not sell. A coordinated network can make the factory feel real pressure. Still, their power has limits. Each store carries its own debt, its own payroll, and its own landlord. When big creditors and rating agencies start driving the conversation, a single dealer group can feel very small. That tension raises a hard possibility. If the financial giants lean in one direction and the dealer body leans in another, do the shops that represent real writers have enough strength left to sway the outcome? Boardroom wars. Over the last several years, Harley has not only been answering to bondholders and dealers, it has also been wrestling with activist investors. These are funds that buy sizable stakes, then push loudly for changes they believe will boost the stock price quickly. Recent history includes a high-profile activist group taking a board seat, later resigning, and blasting the company's direction, even using phrases like cultural depletion. Not long after, leadership in the corner office changed hands. That is not coincidence. That is pressure doing its work. Activists often want sharper cost cuts, clearer growth stories, or breakups that surface immediate value. They tend to dislike slow, uncertain bets and heavy spending on long-term projects. In Harley's case, that can translate into trimming development budgets, dropping slower-selling heritage models, or pushing hard into segments that look better on a spreadsheet than on a cross-country ride. The public rarely sees the memos, yet the tone of earnings calls and product roadmaps tells you a lot about whose voice is winning. Boardroom battles decide which priorities survive when money is tight. That reality forces a blunt worry out into the open. If activists keep calling the shots, how much of the old touring legacy, the slow-baked quality and long-haul focus, will still be standing 5 years down the road? Tariffs and relief. Over everything else, there is one more player that does not ride, does not wrench, and still shapes the whole game: government. Over the past decade, Harley has been hit squarely by trade wars. The European Union slapped retaliatory tariffs on large American motorcycles, pushing total duties to around 50% in some cases. A court ruling later closed a loophole that once let Harley route production through Thailand to ease some of that pain. Those moves made certain export models sharply more expensive overnight. Closer to home, Harley has swallowed tens of millions of dollars in extra tariff costs in recent years, by its own guidance. That money does not come from thin air. Part of it lands in higher prices overseas. Part of it eats margin in markets where writers simply will not pay more. Combine that with a home base already dealing with thin profits, and you can see how policy decisions in Washington or Brussels translate directly into the price sticker a buyer sees under bright lights in a distant showroom. Government levers are slow to move and often driven by politics that have nothing to do with motorcycles. That creates one more unknown in an already tense picture. By the time lawmakers finish arguing over trade and tariffs, will the timing line up in a way that actually gives Harley a fair shot at recovery? Or will the help, if it comes at all, arrive after the company has already been forced into choices it cannot easily undo? Rivals move in. Harley's trouble does not happen in a vacuum. every time a dealer closes or a buyer walks away from a high-priced touring rig, another brand is waiting. Japanese and European makers have watched Harley's market share slide from nearly half of the American heavyweight class to closer to 1/3. To them, that is not a tragedy. It is an opening. They are already filling showrooms with big-bore cruisers and long-legged tourers that promise comfort, reliability, and lower monthly payments. Some of those companies have something Harley has struggled to match lately: a full spread of approachable mid-size machines that feel modern without costing what a small house used to. Riders who might have stretched hard to afford a big American V-twin are instead signing for a Japanese bagger with long service intervals and dealer networks that rarely close. European brands push their own vision of power and handling, offering big twins and triples that can cross states all week and still carve mountain roads on Sunday. A few years of reliable ownership stories from those bikes can reset loyalties faster than most people want to admit. With rivals grabbing showroom space and younger riders, the uneasy thought starts to creep in. If Harley stays weak for too long, how many lifelong owners will quietly switch jerseys and never look back? What happens inside the plants? What happens inside the factories and warehouses will shape that answer more than any ad campaign. Harley's plants are not just buildings full of machines. They are places where skilled welders, painters, machinists, and assembly workers have spent decades learning how to put these motorcycles together the right way. Parts suppliers build entire businesses around feeding those lines. When a company starts talking about restructuring, those people and contracts sit near the top of the risk list. If demand stays soft and margins thin, the pressure to consolidate production grows. Management teams look at every plant and ask which ones earn their keep. Closing a facility can save millions in fixed costs. It also throws hundreds of experienced workers into uncertainty. Once those people scatter, you do not just restart that skill base a few years later by flipping a switch. Every rider who toured the factories in the past has watched that craftsmanship up close. Losing it would not just be a financial move, it would be a blow to the brand's soul. When you picture that chain running from the factory floor to the parts counter at your local shop, a hard question starts to echo. If cost-cutting shutters keep plants or squeezes suppliers too far, where will the next generation of Harley-trained techs and craftsmen learn their trade? Paying interest. Beyond factories and rivals, the long game comes down to money that most riders never see. Once a company lands in junk territory, every dollar it borrows tends to come with sharper teeth. Lenders demand higher interest, tighter covenants, and quicker payback schedules. That is manageable for a year or two if sales are healthy and costs are under control. Stretch it over a decade, and high financing costs start crowding out everything else. New engines, fresh chassis, better touring comfort, and durability upgrades all require steady investment in engineering and testing. When interest expense eats a larger share of each year's profit, the easiest place to trim is often future projects. Executives delay new platforms, extend life cycles on old ones, and push minor updates instead of deep redesigns. Riders still see new model year badges, yet under the paint, the real changes may be limited to a few accessories and a paint scheme. It keeps the marketing machine running without truly moving the product forward. Picture that, over several model cycles, and another uncomfortable issue rises to the surface. If credit stays tight, and investors keep demanding short-term gains, which lines get trimmed first when the company decides it cannot afford to keep every model family alive? What saves the brand? Under all the numbers, what riders care about most is something no balance sheet can fully capture. Harley's greatest asset has never just been tanks and frames. It has been the community of people who rode together, wrenched together, and passed down stories about cross-country trips that changed their lives. Local dealers, riding clubs, and garages built that world over decades. Any plan to save the company that ignores that culture is working with half the picture. If a bailout, buyout, or restructuring is coming, the real test should be simple. Does the plan keep enough strong dealers open in the towns where riders actually live? Does it support parts availability for older machines instead of quietly nudging everyone toward the latest thing? Does it keep at least one line of big, honest touring rigs that a rider can swing a leg over and trust to carry them across 3 states without drama? Those questions matter more to the longtime owner than whatever polished phrase shows up in a press release. When you put all of that together, the question that opened this whole discussion comes back with a sharper edge. The story here is not just whether Harley faces bankruptcy, buyout, or bailout. It is which path can realistically protect the riders, the dealers, and the culture that built the name in the first place. And who will have the courage to choose that road while there is still time to make the turn. However this plays out, boardroom deal, bailout cash, or a trip through bankruptcy court, the numbers are going to land on somebody. The question is whether it's Wall Street or the folks actually riding. Share your take below. Would you ride out a Harley bankruptcy? Or is that the line for you? Drop a comment, hit like if this helped, and subscribe so you're here when the next piece of this story breaks.